In the last video, we talked about what a stock market index is. So an index is a collection of a large number of stocks that gives you a broad snapshot of what's going on in a country's economy, or maybe a single industry or something like that. For instance, the S&P 500 is a very popular index that tracks large and medium-sized American corporations. So knowing what's happening in that gives you a good idea of what's happening in the broad economy to some degree. One thing that's we noticed when we talked about what's wrong with mutual funds is that they're actively traded, and you've got to pay fees for the person who decides, well, we need to sell some of this stock and we should buy that stock over there because that's going to go up and this is going to go down. First of all, you've got to pay that person to make those decisions. And second of all, you've got to pay for all of the fees and taxes involved in making all of those trades. And what researchers saw was that when you think about the average performance of a mutual fund, they found out that the average was actually lower than the average response of the S&P 500. So the S&P 500 over the course of a year might go up by 7%, but the average mutual fund goes up by 5.5%. So not only are you paying for these experts, but they're not even keeping track with the market, not alone, not beating it. And so one investment that has become really popular recently is what's called the index fund. So an index fund is a mutual fund, but it's not trying to beat the market, it's trying to match the market. So the S&P, if an index is tracking the S&P 500 index, that index fund is just going to buy the stocks that are in the S&P 500 index and just in the proportion that makes the S&P 500 calculations work out. So if you turn on the radio at the end of the day and you hear that the S&P 500 index went up by 5% and you've got an S&P 500 index fund, you know that your money in that fund went up by 5% because your index fund is doing exactly what the market is doing. One thing that's really exciting about that is that, first of all, there aren't a lot of fees. They're not doing a lot of buying and selling in that index fund. Another thing is you don't have to pay some expert to research funds. You know exactly what the S&P 500 is. You just program a computer to either buy or sell just enough to make sure that you're covering all of the money that people are investing in or withdrawing from the mutual fund. If you do that, you've got almost no buying and selling going on in your index fund. So that keeps fees really, really low for index funds. And one of the things we will see in the next activity is that those fees really cut into your investment total over the course of 30 or 40 years. So somebody might charge you, a 0.5% or a full percent to manage their fund. If there's a difference between that and one that has a low fee, it's like, okay, well, that's just, $1,000 a year or something like that. But it adds up because of this compound interest over time. And so it becomes a really enormous amount of money. So making sure when you do investments that you've got it not just in funds that are profitable, but in funds that are profitable and have low fees. So index funds are really a great way to make sure that you're never beating the market, but you're never behind the market and you're paying low fees to do that. So the market does really well over time. So keeping track with it is a great way to have a sound financial future.